It seems, VisualEconomik viewers, that the permanence of the euro as the single European currency could be in serious jeopardy.
IMF warns risk of fragmentation in the Eurozone due to the ECB's withdrawal from the market. French Finance Minister Bruno Le Maire said that unsustainable divergences between Eurozone member states could jeopardize the single currency in the long term.
When we talk about the end of the euro, we are talking specifically about a scenario in which the euro could disappear completely, at least as we know it today. There is even talk that Europe could even reverse a large part of the process of economic and political integration it has undergone in recent decades. And keep in mind that this is no exaggeration. We are talking about a danger that many international analysts are beginning to put on the table. Be that as it may, the most pertinent factor is that this danger has not only remained in the analytical, academic, or dare I say it, prophetic sphere, it also seems to have struck a chord in the foreign exchange market itself. Take a look at this.
Euro falls to equal the US dollar for the first time in 20 years.
As you can see, in just 1 year, the euro has gone from being 20% more valuable than the dollar to being worth exactly the same. In fact, at certain times, the dollar has managed to break the parity barrier and become more expensive than the euro, which means that Europeans have seen their purchasing power plummet. And all of this, moreover, in a context in which US inflation, well, what can I say? It was not exactly conspicuous by its absence. But what is the reason for this huge drop in the value of the euro? And why have fears of a fall in the European currency intensified in the wake of the war in Ukraine? Because surely a good part of the explanation is due to the fear of war and the increase of the price of oil, which is typically bought with dollars. However, the euro's problems are not exactly new. The problems that the euro is starting to experience are the consequences of an economic cyst that Europe has been lugging around since 2012, and that today, 10 years later, has once again shown its presence. But what exactly is the problem here? Well, check this out.
New debt crises may hit Europe following monetary policy shifts by the ECB.
Indeed, Europe, essentially Southern Europe, is up to its neck in debt. And it turns out that, until now, this wasn't a problem, because since 2012, the European Central Bank printed money by the bucket load, money with which the Southern European countries were able to stay afloat. However, the era of free money has come to an end.
The ECB prepares to end its debt purchases in the summer due to runaway inflation. The institution highlights the serious deterioration in business and consumer confidence and the rise in prices.
Supposedly, the central bank lifeline will no longer be available to countries like Spain or Italy. This means that unless they make major cuts in their public accounts or raise taxes to levels that would be difficult to withstand politically, these countries will be destined for bankruptcy. Keep in mind, this is a process that could be halted with new central bank interventions, but the problem is structural. In other words, such interventions would only buy some time. In any case, in this video we will not talk about why the countries of the South are heading towards bankruptcy. We've already taken a look at that in other videos. In this video, we will focus on how these bankruptcies and huge public debts could lead to a new euro crisis, a crisis even worse than the one experienced in 2012. A crisis that, as I have said, could mean, in fact, the end of this currency, at least as it exists today. And not only that, but we will also talk about the consequences that this could entail, and finally, we will also explain the possible solutions that could be found for avoiding disaster. Are you ready? Of course you are. So let's get cracking. If we want to understand the euro crisis that is coming, we must first look back at what the first crisis of this currency was like, the euro crisis of 2012. You've probably all heard that at the time there were many fears that the euro would collapse, and you've probably also heard that this was essentially due to the problems of the Greek economy. It is also true that Italy, Spain, and Portugal also had serious problems, but believe me when I say the case of Greece was exceptional. Greece was the only country that had to be formally bailed out by the European community, and it was the only country besides Cyprus to experience a corralito. And as we say formal bailout, because although countries like Spain were also bailed out, those bailouts were not so publicly notorious. Now, what made Greece different from Italy or Spain? And why did Greece have a bailout where the rest managed to get themselves out of the crisis? Answer lies in public debt. When 2012 arrived, Spain and Italy had 86% and 126% of debt respectively. Greece's debt was more than 175%. Not only that, but the Hellenic nation was spending 10 to 15% more each year than it was able to earn. In other words, in 2012, Greece not only had a lot of debt, but also everything pointed to the fact that it was not going to be able to pay it. Meanwhile, Spain and Italy, fortunately, were not yet so indebted to fall so easily. Be that as it may, the key issue is that in the face of the imminent Greek bankruptcy, three possibilities were raised. First, to enter a definitive bankruptcy and default on the public debt. Second, to have Greece exit the euro to print its own money to pay debts. And third, wait for a miraculous bailout from Europe and cut public spending. And the question is, which of all these options was the best? The truth is that the first option was foolhardy. That is, not paying the public debt meant bringing the banking system to complete collapse. Remember that at the time, banks owned a lot of public debt, and if that debt defaulted, the bank would run out of funds and customers would lose all of their money. In fact, this is something that, in a way, happened. There was a percentage of the Greek debt that was effectively defaulted on, something that led to the financial collapse of Cyprus and the loss of the savings of a multitude of people.
Europe already has its first corralito. Thousands of Cypriots try to withdraw their money after learning that part of their deposits will be withheld.
The second option, which is the one that we are interested in, was to exit the euro. If Greece left the euro, then it would have its own currency and it could pay its debts with it. Of course, that would involve printing banknotes out of thin air and thereby creating massive inflation. But the point is that it could technically do it. If you think about it, for politicians, this would have been the perfect choice. On the one hand, they would have regained power over their country's currency, and on the other hand, they could have continued with their populist measures of disproportionate spending, even at the cost of galloping inflation. However, there was one problem, and you will say, what problem? In short, in order to leave the euro, Greece would have had to have blocked the euro deposits of Greek citizens. Basically, it would have had to steal the euros from the citizens and give them to Greece's new currency in exchange. And as you can imagine, this would have been a tremendously unpopular measure. In fact, during the worst moment of the crisis, it was feared that the Greek government would actually carry it out. And you know how the citizens responded to the fear of the exit from the euro? By doing this.
Depositors have been pulling their funds out of Greek banks on worries that the country's financial sector might collapse if Greece left the Eurozone.
As you can see, leaving the euro was not an option supported by the popular will, so finally the option that was used to solve the debt crisis was the third one. The European Central Bank rescued Greece by giving them money to pay what it was owed and managing to save itself. Although, hold on a minute, because I know what many of you are thinking. Greece leaving the euro did not mean that the euro would disappear. That is, Greece could leave the euro, but the rest of the countries would continue to use the currency without problems. And in part, it is an argument that makes sense. The thing is that at the time, it was thought that the fall of Greece from the eurozone could cause a chain reaction that would end up dragging the rest of the countries with it. If Greece had left the euro, other countries such as Spain or Italy would have adopted the same strategy. In any case, there is one thing we must be very, very clear about. At the end of the day, Greece was a small economy. Even if its problems were very serious at the European level, they were not an unsolvable issue. And in fact, we have already seen that in the end, they could be solved. But what about Italy and Spain today? Could a Greek-style bankruptcy be resolved today, but in the rest of southern Europe? Well, everything suggests that it would be very complicated. Not only are Spain and Italy much larger economies than Greece, but their current debts are more than 10 times, you heard that right, 10 times the Greek debts that almost caused the end of the euro in 2012. And not only that, in addition, Europe finds itself in a context where inflation rates are very high and where the deficits of the southern countries seem to be irredeemably worsening. Thus, a new European bailout looks to be very complicated. But then, are there any feasible solutions to Europe's debt problems? If so, what would the solutions entail? And, perhaps most importantly, if the possible solutions eventually fail, how would that translate into the possible end of the European currency? Let's find out.
Avoid bankruptcy.
The first solution to the European debt problem is, controversial though it may be, inflation. If the European Central Bank decides to keep inflation rates high, say 5 to 10% as we're currently experiencing, money will be worth less and less, and then government debts will be worth less and less. As many of you already know, this is what we've done in countries like Venezuela and Argentina, and although their cases have been anything but an economic success, it could certainly be a very effective way to tackle the debt problem. However, don't forget this solution has a major drawback.
Finland prefers to leave the euro rather than pay the debts of countries like Spain. Netherlands almost left the euro in 2012 to block Germany's plans.
Unfortunately, or unfortunately for Southern Europe, there was a great opposing force that would hardly allow inflationary measures of the caliber of Latin American countries to be adopted. We are talking about the famously frugal countries. You see, if the European Central Bank decided to increase inflation so that Spain could pay its debts, that inflation would also seriously affect the savings and economic stability of the rest of the European countries. Countries that have controlled their finances and have been responsible with their debt levels. In other words, to promote inflation would be to punish the northern countries, something that everything indicates they would never accept, and that would provoke their immediate exit from the euro. Not to mention that pursuing higher inflation would also go against the outstanding principles of the ECB, or that it could devastate forever the very high value of the European currency, or even the productive structure of all of these countries. Well, let's not go down that road. Let's imagine that new governments arrive in the countries of the north and that they kindly accept to maintain sustained inflation in order to save the south. Well, bad news. Even that would be no guarantee that the debt problem would end.
Revaluing pensions with the CPI could increase their expenditure to 14% of GDP in 2023. Each point of deviation from the CPI costs 1,700 million more in pensions and public spending, and benefits will exceed 188,500 million next year.
A peculiar feature of public or government spending in these countries is that it is linked to inflation. That is, even if inflation were to make Spanish debt smaller, it would in turn increase public spending on pensions, income transfers, and public servant salaries, which account for more than 50% of the public budget. And yes, I know what you're wondering. Couldn't something be done so that these spending items don't increase so much with inflation? In fact, as an example, back in 2012, pensions in Spain were already decoupled from inflation. However, pensioners are too large a constituency for politicians to be interested in cutting back, so pensions were once again linked to the CPI.
Sanchez will approve the updating of pensions with the CPI next Tuesday. The Spanish government reaffirms its commitment to raise pensions in line with the CPI, despite warnings from Brussels.
So, I don't know. I think if anything is clear to us after all this, it is that inflation does not seem an infeasible solution. But wait a minute, because there is another solution that might be perpetual bonds. These are bonds with no maturity date. Let's say that perpetual bonds are a good way for Europe to borrow as a whole and allow southern countries to pay lower interest rates. In a way, this could be the famous Eurobonds. Although, one moment, because we have another problem again.
The Dutch Parliament refuses to issue Eurobonds against the coronavirus.
Indeed, friends, issuing Eurobonds would again go against the interests of the northern countries. Firstly, because it forces them to pay debts in case the south does not pay them, and secondly, because it would lead to a new interventions by the ECB, which would put downward pressure on interest rates from which their citizens who have savings could benefit. These northerners seem like real devils. How is it possible that they do not want to buy a few Eurobonds to help the poor south of Europe that has been immediately drowned in its debts? Debts that can only be paid by northern Europeans. Well, better said, by northern European money. What a bunch of non-team players. Did the politicians of southern Europe ever realize the consequences of their electioneering policies? But hey, wait, because perhaps the frugal countries have been demonized more than necessary. And the fact is that these countries have actually offered their help, although of course they have not offered it in exchange for anything. They are not fools.
If the South needs help from other countries to manage the crisis, and I understand this because they have a little financial leeway to do so, it is reasonable that we ask for a clear commitment to reforms. If loans are converted into transfers, reforms are even more crucial, and an absolute guarantee that they will take place is needed. Mark Rutte, Prime Minister of the Netherlands.
The point is that if frugal aid is not supported by structural change in the accounts of the countries of the South, this aid will serve no purpose in the long term. Remember that countries like Spain will need up to 14% of GDP to balance their accounts in the coming years. And friends, I guarantee you that no Eurobond can fix that. In any case, a Eurobond could be a breath of fresh air in the form of a couple of points of gross domestic product, a momentary relief that would give an important margin of a few years to balance the southern accounts without too much pressure. But of course, Eurobonds do not work magic if they are not accompanied by serious commitments to reform. They would only serve to delay and worsen the problems even more. That is why the northerners don't want to help in exchange for nothing. And what can I say? It makes perfect sense. Wouldn't you do the same with your own money? Well, exactly. Now these two solutions have been European-style solutions, diplomatic and reasonable. But what would happen if the southern countries decided to just go bankrupt? What would happen if one day the politician on duty wakes up in the morning and says, well look, unless I cut public spending or increase taxes, I go bankrupt. If I can't pay the debt, I won't pay it. Period. Let's take a look.
If I've seen you, I don't remember.
When we talk about bankruptcy, about not repaying the public debt, we are talking directly about the fact that many companies, individuals and institutions will lose a large part of their savings. But all of the debt owners who stand to lose their money, two in particular stand out: commercial banks and the European Central Bank. In the first instance, as we have explained before, and as has happened in Cyprus in 2012, if the countries of the South do not pay the debt owned by commercial banks, it is possible that many of them will go bankrupt, swallowing a large part of their clients' money. And here comes the interesting part. In Europe, there is a central bank insurance that covers up to 100,000 euros of each bank deposit after a bank failure. The problem is that this insurance is very slow. It takes a while to work, and in cases like Cyprus, it even required the merger of several banks. So let me ask you, do you think citizens would be willing to wait so long for their money without being able to use it? Surely you can imagine that. No. It would then be that politicians would again have enormous incentives to exit the euro and replace those deposits with their own currency. On the other hand, bank failures could cause enormous distrust in euro-denominated assets and European investments. And what does this mean? Well, the euro would foreseeably depreciate enormously, causing thousands of people to lose the value of their savings. And as you know, for the northern countries, this would not be a particularly attractive situation. So again, they would have many incentives to abandon the euro as well. In other words, neither the south nor the north would want to keep the single currency. However, there is something worth mentioning. More than 40% of debt of southern countries does not belong to commercial banks or small investors. This debt belongs to the European Central Bank. If only this debt were to be cancelled, then no commercial banks would fail. So is that a feasible option? Well, for some politicians, it seems so.
PSOE and Podemos, the parties that form the Spanish government, ask the ECB to forgive the debt of European countries.
However, no matter how much politicians ask and ask, the central bank is very clear about its direction.
ECB President Christine Lagarde denies debt forgiveness. This rule is one of the fundamental pillars of the euro.
If the central bank does not want to forgive the debt, it is mainly for 3 reasons. Firstly, because it is illegal and would go against the founding principles of Article 123 of the Treaty of the Functioning of the European Union. Secondly, because it would send a signal to the member states that they could continue to go into debt left and right without consequence. And thirdly, because giving the resources to the countries of the south by forgiving their debt, while losing assets available for sale in the market with which to execute monetary policies, the ECB would be opening the door once again to galloping inflation. Not to mention the loss of central bank independence, the loss of seigniorage benefits for the rest of the countries, and the international reactions that this would produce. In short, this video could go on for much longer, but in summary, we should stick to one main idea. The stability of the euro will depend on the southern countries adjusting their accounts as soon as possible, and this may happen voluntarily or as a result of an obligation imposed by Europe, an obligation that seems to be emerging recently.
From 2023 onwards, a gradual fiscal adjustment in heavily indebted member states needs to start in order to stabilize and then reduce debt ratios. European Commission Communique.
Whatever the case, VisualEconomik viewers, at this point, it's over to you. Do you think that politicians will be able to correct the situation before it is too late? What do you think will be the ultimate solution to the debt problems? Do you see a long-term future for the European currency? You can leave us your answers in the comments below. And as always, don't forget that here on VisualEconomik, we release new videos every week. So subscribe to this channel and hit the little bell button down there so you don't miss any of our updates. If you like this video, like it so we know. All the best, and I'll see you next time.